Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500, on the stock market, and we're going to start off this video by quickly covering the long-term valuations of the S&P 500. Now, a few of our members at gameoftrades.net have asked us this question: how is it possible to have an optimistic outlook when valuations do not look attractive? And this is a chart on the trailing 10-year nominal earnings yield on the S&P 500. Now, this is a way to measure valuations. It's essentially the inverse of the PE ratio. It takes a look at the earnings of the S&P 500 and divides it by how expensive it is. And so when you have a very, very low earnings yield, that means you're paying a hefty price for how much companies are actually making. And so this is a chart that actually goes back 110 years, back to 1910. And you can see there's only been one other time where we've had valuation, so earnings yield this low, and it was in 2000. Now, we believe that one of the primary driving factors behind this phenomenon has been the decline in the 10-year yield. So bond yields that since 1982 have continued to move down and down and down. And so as bond yields have gone down, market valuations, PE ratios have gone up, leading us to these completely irrational valuations, exuberant valuations. Does this actually predict anything? And the answer is yes, it matters a lot. You can see this is a chart of the 10-year earnings yield, the trailing 10-year earnings yield, against S&P 500 returns. And you can see the lower the earnings yield, the closer it is to zero, the lower S&P 500 returns you're going to have. When you have a high earnings yield, that's when you can expect massive returns over the next 10 years. For example, in 1933 here after the Great Depression, or in 1980 here right after the secular bear market in equities, you had valuations that were very attractive, and so you could actually expect somewhere around 300 to 400% returns over the next 10 years. It's around 2-3% here, and you can see statistically, if we use the line of best fit here, it should give us around 50% return. The S&P 500 should give us around 50% forward returns over the next 10 years. And you can see around these levels, a lot of times it actually goes negative, where you can actually lose money over the next 10 years. And that is a scary, scary thing to think about, because 10 years is a long time, and seeing 0% return over a period of 10 years is absolutely something you want to avoid as an investor. But this is only part of the story. There's a lot more to consider than just the 10-year forward returns. That's exactly what we're going to cover in the rest of this video. By the way, if you're so far enjoying this episode, don't forget to leave us a like. It really, really helps our videos out. Subscribe to the channel if you haven't already, if you want to learn more about the market, you want to find out what's going on, and see all these crazy charts that we spend a lot of time putting together and finding the best way to present it to you guys. So now I want to show you a second chart here. And this is a lot more short term. This is a lot less focused on the longer term picture where we have these exuberant market valuations and low forward expected returns. This is a chart that's telling us that the risk reward here is extremely favorable to the upside. This is the gamma exposure to market cap ratio, and this is essentially the sensitivity of options to market movements. So when this ratio is extremely high, for example, back here in around February 2020, it means the slightest move down in the market is going to cause a panic for traders who are holding call options, because those call options are going to devalue very quickly. That's what gamma exposure is. But when gamma exposure is all the way down, it's telling you the slightest move up in the market is going to trigger massive reward for people holding call options, and traders who are holding put options are going to have to sell very quickly, and that can trigger upside moves very rapidly, short squeeze moves that leads to a powerful market reversal. You can see that happen right here in 2018, December 2018. We saw this gamma exposure reading extremely low. Same thing in COVID here Gamma exposure very, very low. Again, in 2016 here, right at that significant bottom, gamma exposure extremely low. This was so much fear back then. So many investors concerned about a continuation of the 2008, 2009 bear market. And look at that short squeeze recovery just within a few months here. So 175 days, you saw a 33% rally off that low. And again in 2016 off the low here, just in 170 days, 20% off the low. In 2018 here, in 100 days, 26% off the low. And during COVID, 100 days later, you were at 46% off the low. This is what can happen when everyone's on the same side of the boat. Traders have loaded up on puts, and so these investors are vulnerable to getting short squeezed very, very rapidly on an unexpected move up. And a move up now would definitely be unexpected by a lot of people. This is how market psychology works. When you're in a downtrend, the market's moving down, everyone's focused on the bad news. You only hear bad news, bad comments, very pessimistic outlooks. Nobody can think of a reason why the market could get back to its all-time high. And yet when the market is at its all-time high, it seems ridiculously obvious. And investors who are pessimistic at those moments are considered fools and perma-bears, but that doesn't change the fact that earnings yield is extremely low. But I'm going to give you a quick example here. For example, 1966 right here, where you had this 1966 to 1970 period here. You had a correction, earnings yield rose, so valuations got a little bit more attractive, and that could have been perhaps the beginning of an equity bear market where valuations get crushed, very similar to today, where we've had these slightly more attractive valuations compared to 2021. And this could actually be the moment where we see this massive bear market in equities. But look at what happened in 1966. Let's go back here. The market right after that small correction here, this was a 24% correction off the all-time high. The market recovered and rallied a staggering 50% in a powerful blow-off top type of move here. So this is just one example of a moment where the market made a massive rally, a massive blow-off top, despite the fact that valuations were not attractive at that moment. And if we add inflation here in blue and the Federal Reserve interest rate in orange, you can see that rally was triggered when all of the bad news around inflation and around a tightening of monetary policy, all of that bad news that occurred in 1966, they actually turned into good news in 1967. We think there's a very, very similar setup today, which is why we think dips in the current market environment are buying opportunities, but those longer term risks are definitely there. And following that rally in 1966, in 1967, 1968, look at what followed. A secular bear market. If the war in Ukraine escalates and goes out of control, inflation would continue soaring. Maybe we see the global financial system collapse over the next few months. That would trigger a secular bear market now. But that's not what we're betting on right now. Our investments, our bets, our model portfolio, it's going to be coming very soon at gameoftrades.net. We are betting on this setup that we think is very attractive for the next few months, but we need to be aware of those longer term risks as investors because the data is there, and looking out 10 years, we definitely have a very pessimistic outlook on what the future holds for equities. Now let's quickly take a look at the technical picture on the S&P 500. We had the Federal Reserve announce a 75 basis point hike here this week, and ever since that announcement, we've actually seen the S&P 500 rally almost 4% from that announcement. This is a big move, very powerful move. And so a lot of people are considering this completely ridiculous, that the market is rallying after a 75 basis point hike, which is absolutely massive right? So why could that be happening? The big reason for that, in our opinion, is because the market is front running the rest of the Federal Reserve hiking cycle. The market is seeing the economy slow down and inflationary pressures coming back down as well. Bond yields have been breaking down here. And so these are all signals that the market, the financial markets, are anticipating a reversal in Federal Reserve monetary policy. And so that's what's happening right now. The market is already front running the Fed cycle. Now, this is something that we've been talking about for a few months now. This is something we've been anticipating and preparing for, positioning on these dips as we saw these buying opportunities. Now, objectively, from a technical standpoint, we are clearing some pretty important resistance levels. This is one of them that we were looking at, a big neckline resistance. We're trying to move above that right here. You also had a small price channel here that I'm going to draw out from connecting these two lows here. If we copy and paste that, move that to the top of the channel, you can see we have a reaction here, a top here, and we're breaking out above that. So this is a nice confluence of resistance, and the market is trying to break out above that. A bullish development would be to see a real move higher and to see price hold above this zone. Lots of resistance around 4K. We need price to hold above 4K. In terms of big resistance levels, this is one that I'm looking at very closely here at around 4,300 points. That's going to be a tough one right there. And then you've got 4,200 points. That should also act as a level of resistance. The market doesn't go in a straight line. You're going to get pullbacks along the way, whipsaws, which is why we're focusing on the macro strategy. There's still lots of resistance overhead. We're still in a downtrend. Our opinion is that this dip here has been a major buying opportunity, but as we've seen throughout 2022, you have to be prepared to all outcomes. You have to be prepared potentially seeing a retest of that low before the bull run really does materialize. And that's especially if you see inflation pop its head again, you could see this move fail. But this move here that we're seeing today is undoubtedly very constructive. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to smash that subscribe button and click on that like button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.